Imagine a U.S. drone ship fires a missile at a military target in the Middle East, and then, less than an hour later, your retirement portfolio in California just loses thousands of dollars because microchip companies are suddenly deemed too expensive to run.
Yeah, it's wild. It's just a stunning display of global interconnectivity. We naturally want to compartmentalize the world, you know.
Right, like putting things in neat little boxes.
Exactly. We put geopolitics in one box, the technology sector in another, and banking in a third. But in reality, those boxes do not actually exist.
And that is exactly what we are exploring in today's deep dive. Welcome in, everyone. Today we're taking a massive stack of incredibly intense, fast-moving source material, all dated July 13th, 2026.
It's a heavy stack today.
It really is. And we're going to trace the nerve endings of the global economy for you. Our mission today is to help you understand the hidden mechanics that connect a naval blockade to a frantic economic warning about artificial intelligence.
Right, and how all that volatility forces these billion-dollar energy and banking corporations to just completely restructure themselves simply to survive.
So we're not just going to read you the headlines, we're looking under the hood.
Yeah, we need to understand the why and the how behind the cascading effects of a single, highly chaotic day in the markets.
So let's start at ground zero of this economic shockwave, the Strait of Hormuz.
Let's do it.
For you listening, here is the baseline scenario unfolding in our sources. President Donald Trump has declared the return of a U.S. naval blockade on Iranian ports.
And the catalyst for this was an Iranian attack on a container ship, which, well, it immediately triggered U.S. military strikes on dozens of Iranian sites.
Right. And if we look at the specific nature of those U.S. strikes, there's a very clear escalation in the mechanics of modern warfare. The sources detail hits on traditional targets, air defense systems, radar sites, missile and drone equipment.
But the standout detail, and this is unprecedented, is the first ever use of U.S. drone ships to strike an Iranian submarine and its maintenance facility while it was in port.
Wait, using unmanned surface vessels to take out a submarine?
Yeah, no humans on board the attacking vessel.
That's a massive leap in maritime combat capabilities. It takes the human risk entirely out of the equation for the attacking force.
It really does, which significantly lowers the threshold for executing a strike in the first place.
Right, because you aren't risking your own sailors.
Exactly.
Yeah.
And Iran's response was equally calculated. They didn't just lash out randomly.
No, the Revolutionary Guards fired missiles at U.S. military targets and bases in Jordan. They triggered sirens in Bahrain where projectiles were shot down.
Yeah, and they attacked a consulate, border points, and a maritime oil drilling platform in Kuwait.
And if you look at a map, Jordan, Bahrain, and Kuwait are essentially the anchor points of the Allied security architecture in that region.
Right, so hitting them isn't just about causing damage. It's sending a very loud message that the entire regional network is vulnerable.
But the geopolitical back and forth isn't even the most disruptive part of this story for the markets. The real earthquake hit the global supply chain when President Trump announced on Truth Social that the U.S. will now act as the guardian of the Hormuz Strait.
And the policy attached to that guardianship is what sent the markets into an absolute tailspin.
Yeah, let's unpack that policy.
So the U.S. intends to charge a 20% fee on all cargo shipped through the strait to reimburse security costs.
20%.
Yes. The assertion is that while Iranian ports are blockaded, all other nations will have fair and open use of the strait as long as they pay this toll.
Of course, Iran's foreign minister, Abbas Araghchi, immediately mocked the U.S., claiming Iran is the true guardian of the strait and refusing to allow U.S. interference.
Meanwhile, mediators like Pakistan, Qatar, and Oman are just scrambling to salvage a peace deal.
But I really want to pause on this 20% toll. Let's break down the sheer economic friction of this. Setting up a 20% toll in the Strait of Hormuz is like a single town deciding to put up a private toll booth on a major interstate highway.
That's a great way to look at it.
Only in this case, roughly a fifth of the world's total oil and liquefied natural gas passes through that specific choke point.
Right, the toll booth analogy is perfect because it highlights the inescapable nature of the geography there. The Strait of Hormuz is only about 21 miles wide at its narrowest point.
Wow, that's narrow.
And the shipping lanes themselves are just 2 miles wide in either direction. You simply cannot bypass it if you are moving oil out of the Persian Gulf.
Now, it's worth mentioning that the International Maritime Organization, the UN agency that oversees shipping, has stated that mandatory tolls in international straits have no legal basis.
Under the UN Convention on the Law of the Sea, exactly. which guarantees the right of transit passage.
So you have international law colliding head-on with a physical military reality. Because if a carrier strike group is demanding 20%, the legal debate takes a backseat to the physical one.
Oh, absolutely. The physical reality always wins in the short term.
But how does that 20% actually translate into the price of a barrel of oil for the consumer?
Well, think about the margins in global commodities. The price of oil is determined by this highly sensitive, fragile balance of global supply and demand.
Right.
Even a 1 or 2% disruption in supply can cause massive price spikes. So if you slap a 20% premium on transit costs for a fifth of the world's supply, you are fundamentally shocking the system.
Because shippers have to pay the toll, plus insurance premiums for vessels entering a conflict zone just skyrocket.
Exactly. And all of those costs are instantly passed on to the buyer.
And we saw the immediate result in the markets. Brent crude, which is a global benchmark for oil prices, spiked 7.8% to nearly $82 a barrel in a single session.
Which makes total sense. Oil goes up when the Middle East gets volatile. That is economics 101.
Right, completely expected. But here's the piece that feels entirely counterintuitive to me. Why on earth did U.S. tech and chip stocks completely tank on this news?
This is where it gets really interesting.
I mean, the S&P 500 opened lower, the Dow dropped, but the tech-heavy NASDAQ 100 dropped nearly 2%. NVIDIA slid 3.5%, Intel dropped 6.1%, SK Hynix fell 8.6%.
Yeah, it was a bloodbath for silicon.
So how does a naval blockade on the other side of the planet cause microchips to bleed in Silicon Valley?
This is where we see the nervous system of the global economy light up.
Yeah.
To understand the connection between a barrel of crude oil and a silicon wafer, you have to look at the primary buyers of those chips right now.
Okay.
Who is driving the astronomical revenue of companies like NVIDIA?
Well, that would be the hyperscalers, Microsoft, Google, Amazon, Meta, the companies building the massive data centers required to run artificial intelligence.
Precisely. And building and operating artificial intelligence infrastructure requires an unfathomable amount of electricity.
Just massive power grids.
We are not talking about standard data centers anymore. We are talking about gigawatt-scale facilities. So when the price of oil spikes by nearly 8% in a day, it acts as a leading indicator for global energy inflation.
Oh, I see.
The projected cost to power these AI data centers over the next 5 to 10 years just shifted dramatically upward.
So an energy-driven inflation spike makes the operational costs of AI vastly more expensive overnight.
Exactly. The market is incredibly forward-looking. It instantly prices in the fear that these hyperscalers will be forced to scale back their capital expenditures, their CapEx, on AI infrastructure.
Because the underlying energy costs are suddenly looking prohibitive.
Right. If Microsoft or Google decides to delay building a new data center because power is too expensive, they also delay their order for 100,000 NVIDIA GPUs.
Wow.
So a drone strike in the Strait of Hormuz directly and immediately results in a massive sell-off of semiconductor stocks.
That is just incredible. The physical world asserting its absolute dominance over the digital world.
It's a stark reminder.
And honestly, if you're a CEO or an investor watching this, it is terrifying. Which brings us perfectly to the next major piece of our puzzle. We just saw how fragile the global economy is to a physical energy choke point.
Yeah, and now we are pivoting to an even bigger systemic economic disruption, one that top experts are actively warning we are entirely unprepared for.
We are talking about the macroeconomic impact of artificial intelligence.
Right, and our sources detail a massive coordinated warning. Over 200 economists and AI researchers issued a joint statement
titled, "We Must Act Now," a statement on AI's transformation of the economy. And to be clear for you listening, this isn't a fringe group of tech bloggers sounding the alarm.
Not at all.
This coalition includes 16 Nobel laureates in economics. We are talking about heavyweights like Michael Spence, Daron Acemoglu, and Joseph Stiglitz.
Yeah, when economists of that caliber, individuals who have spent decades analyzing long-term macroeconomic trends, labor dynamics, and wealth distribution, when they issue a joint statement with that level of urgency, the financial world pays very close attention.
I would hope so.
The initiative was organized by prominent thinkers like Anton Kornick, Eric Brynjolfsson, Ajay Agrawal, and Tom Cunningham.
And their core warning is incredibly stark. They argue that AI could reshape the global economy on a scale larger than the Industrial Revolution, but in a fraction of the time.
Yes.
The quote that really stood out to me from this statement was this: "Steam, electricity, few years.
The distinction they're making there between speed and scale is the absolute foundation of their argument.
Unpack that a bit for us.
So the anxiety driving this letter is not the science fiction trope of rogue, self-aware robots taking over the world. It is highly grounded mathematical anxiety about labor markets, the rapid concentration of wealth, and the sheer inability of our public institutions to keep up.
Right. Let's put some numbers to the scale part of that equation because the forecasts they reference are staggering.
They really are.
PwC estimates that AI will contribute $15.7 trillion to the global economy by 2030.
$15.7 trillion.
Just to contextualize that, $15.7 trillion is roughly equivalent to adding the entire GDP of China to the global economy in just a few years.
It's mind-boggling.
McKinsey estimates that generative AI alone adds $2.6 to $4.4 trillion annually. And IDC forecasts that worldwide AI spending will hit $749 billion by 2028.
Those forecasts certainly highlight the scale. But again, it is the speed that is keeping these Nobel laureates awake at night.
Why is the speed so much more dangerous this time?
Think back to the Industrial Revolution. It was a massive disruption, yes, but it largely automated manual physical tasks first, like weaving textiles.
Right.
It took generations for that transition to fully play out across the economy. That slow rollout gave society the necessary time to build entirely new educational systems, establish modern labor laws, and create social safety nets like unemployment insurance.
Because things move slowly enough for the government to react. But AI is attacking a completely different segment of the economy.
Exactly. AI is not targeting manual labor. It is targeting cognitive and professional services, and it is doing it all at once.
Across every industry.
Yes. We are talking about legal discovery, healthcare diagnostics, software development, financial analysis, and copywriting. It is hitting the knowledge economy simultaneously across multiple sectors.
Okay, hold on, though. I have to play devil's advocate here for a second.
Please do.
We've heard this end-of-work story before. The mechanical loom, the printing press, the internet, personal computers, every single major technological leap came with widespread panic that it would permanently destroy the workforce.
True.
And yes, there is always acute disruption, but historically, those technologies ultimately created more jobs, more wealth, and entirely new industries that people couldn't have even imagined. Why should I believe Michael Spence or Darren Acemoglu when they say, this time is actually different?
It is the most important pushback you can offer. And honestly, it is the crux of the debate in modern economics right now.
Okay.
The Nobel laureates address this directly by focusing on two things: the unprecedented velocity of adoption and the institutional friction that creates. Our current institutions, our tax codes, our university curriculums, our corporate retraining programs, they are built for what Ajay Agrawal calls a pre-high-fidelity prediction world.
What does that actually mean in practice, though? A pre-high-fidelity prediction world?
It means our societal systems are designed to adapt slowly. If a manufacturing plant closes in Ohio, the local economy takes a massive hit, sure, but the town generally has a decade to try and transition its workforce, attract new industries, or retrain workers for different fields.
Right, the friction is manageable over time.
Exactly. But if the entire cognitive economy transforms in 5 years instead of 50, the friction becomes an acute systemic crisis.
Because everything hits at once.
Right. The friction is the time gap between a white-collar worker losing their job to an AI agent and that same worker being fully retrained for a new, higher-level role that AI cannot perform.
And if that gap is too wide, or if it happens to 10 million people simultaneously, the system just breaks. You get a severe and rapid concentration of wealth.
Precisely. Because during that gap, the people who own the capital, the ones who own the AI models, and the compute power, they reap massive exponential productivity gains.
While the displaced knowledge workers have no income.
Right. The middle class gets hollowed out at hyperspeed. The statement makes a very clear, crucial point. The economic impact of AI is not predetermined by the technology itself. It is entirely determined by our policy choices right now.
Meaning, do we incentivize corporations to use AI to complement human workers, like giving a doctor an AI assistant to help them see twice as many patients with better accuracy? Or do we incentivize them to use AI to simply imitate and replace humans to gut their payroll costs?
Exactly. Do we tax capital and labor differently? Do we rewrite intellectual property laws? The economists are demanding an all-hands-on-deck approach to policy design right now because waiting for the models to fully mature before writing the laws means arriving years too late.
So, If you are a CEO navigating all of this, if you are watching the physical supply chain get choked off in the Strait of Hormuz, inflating your energy costs while simultaneously facing a technological tsunami that threatens to upend your entire workforce, how do you actually survive?
Well, you seek safety in numbers. You bulk up.
Consolidation.
Exactly. When the external macroeconomic environment becomes profoundly unpredictable, corporations try to gain control over the variables they can actually manage. And in corporate finance, the ultimate life raft is scale.
Which brings us perfectly to the massive corporate actions crossing the wire on this exact same day in our sources. Let's look at how the energy sector is building its fortresses.
Let's do it.
Our sources detailed a massive transaction where Greenfire Resources is buying privately held Canada Oil and Gas for $1.28 billion in cash.
This is a textbook consolidation play driven by geography and operational synergy. It's deeply rooted in the mechanics of heavy oil production.
Right, let's look at the map for a second. Connochar owns the Great Divide oil sands operations. Greenfire owns the Hanging Stone property. And these two massive properties are located directly next to each other in Alberta, Canada, just southwest of Fort McMurray.
The physical proximity is the entire rationale for the deal. In the Canadian oil sands, you aren't just drilling a traditional well.
It's not like Texas.
No, not at all. You are dealing with highly viscous, heavy bitumen. Extracting it requires a very specific process like steam-assisted gravity drainage or, say, GD.
Wait, break down side GD for us. How does that actually work?
Essentially, you drill two horizontal wells, one directly above the other. You inject massive amounts of high-pressure steam into the top well to heat up the heavy oil in the ground.
Literally melting it.
Exactly. Melting it so it flows down into the bottom well where it can then be pumped up to the surface. It requires enormous, capital-intensive infrastructure, steam generation plants, water treatment facilities, complex pipeline networks.
Okay, so by buying the company literally right next door, Greenfire expects to unlock $30 million in annual cost savings.
Huge savings.
It's like buying the house next to yours, tearing down the fence, and realizing you only need to pay for one lawnmower, one snowblower, and one driveway repaving. You consolidate the heavy overhead.
That's a very domestic analogy, but highly accurate, yeah. They can share steam generation, optimize their pipeline routes, and consolidate their workforce.
But what is truly fascinating about this specific merger is the financial engineering required to pull it off. I mean, raising $1.28 billion in cash during a volatile macroeconomic period is incredibly difficult.
It is.
According to the sources, Greenfire is paying for this using a bridge loan, which they immediately plan to pay off by conducting a $575 million rights offering.
Right. There are a lot of moving parts here.
We really need to unpack this terminology because this is heavy financial mechanics. Let's start with the bridge loan. What exactly is that?
A bridge loan is exactly what it sounds like. It is a short-term, temporary loan designed to bridge a gap in funding. Greenfire needs the $1.28 billion right now to close the deal with Connochar.
So they just borrow it short term?
Yes, but bridge loans are notoriously expensive. They carry very high interest rates because they are inherently risky for the lender. Greenfire does not want that high-interest debt sitting on their balance sheet for long, especially with oil prices swinging wildly based on events in the Middle East.
Right. So to pay off that expensive bridge loan quickly, they are doing a rights offering. The sources say the subscription price won't exceed $6.74 per share, which is a 15% discount to the recent volume-weighted average price, or VWAP.
Let's translate that for the listener. A rights offering is a defensive capital-raising maneuver. Instead of going to a bank for a long-term loan or doing a public stock offering that dilutes everyone, the company goes to its existing shareholders.
Kind of passing the hat around internally.
Exactly. They say, we are issuing new shares, and because you already own the stock, you have the right to buy these new shares before anyone else, and we will give you a 15% discount on the current average market price.
And real quick, the volume-weighted average price, or VWAP, is just a truer measure of the stock's recent value, right? Because it factors in not just the closing price, but how many shares were actually traded at various prices over a given period.
That's exactly right. It's much harder to manipulate than a simple closing price.
But if I'm a minority shareholder in Greenfire, This puts me in a really tough spot.
How so?
Well, I either have to cough up more cash to buy these discounted shares, or I pass on it, and my ownership percentage of the company gets diluted because millions of new shares just flooded the market.
Is classic squeeze, yeah.
And what if the macroeconomic climate is so bad that the shareholders just say no? What if they don't buy the shares? Doesn't Greenfire default on that massive bridge loan?
That is the existential risk of a rights offering. But Greenfire has a massive safety net in this deal, and this is where the real power dynamics of corporate finance show up.
Right, the standby commitment. Our sources highlight that Waterous Energy Fund, or WEF, which already owns a dominant 72% of Greenfire, is providing a standby commitment for the entire $575 million.
This is WEF flexing its massive capital muscles. A standby commitment means WEF is legally guaranteeing the success of the rights offering.
Basically acting as the ultimate backstop.
Exactly. They are telling Greenfire, go ahead and offer the discounted shares to the minority shareholders first. But whatever they refuse to buy, we promise to step in and buy ourselves.
Wow.
It completely de-risks the transaction for the banks providing the bridge loan. They know they're getting paid back no matter what.
And it essentially allows WF to consolidate even more ownership of the company if the minority shareholders don't participate. And it's really worth noting the broader context here. WEF's Adam Waterous is also the executive chairman of Strathcona Resources, which recently tried a hostile bid for Meg Energy.
They are very active.
Yeah, this fund is aggressively trying to roll up and consolidate the entire Canadian oil sands sector. So, connecting the dots back to the beginning of our deep dive, this massive cash-heavy consolidation is a direct reaction to the global instability we saw with the Strait of Hormuz.
Absolutely. When the price of your core commodity is subject to violent geopolitical whiplash, your only defense mechanism is relentless operational efficiency.
Because you can't control the price of oil.
Right. But if Greenfire can lower its per-barrel production cost by combining SAGD facilities with Conacher, they lower their break-even point. They can survive price crashes that would bankrupt a smaller, less efficient operator. In a world of macro shocks, scale equals survival.
Which provides a seamless transition into our next sector, because it's not just the energy companies pulling up the drawbridges.
No, it's everywhere.
The banking sector, the very nervous system that provides the capital for everything else we've talked about, is also executing massive mergers to ensure its own stability without taking on more risk.
We are moving from the consolidation of physical energy to the consolidation of financial capital.
Let's talk about the creation of what our sources are calling a Pacific giant. First, Hawaiian is buying Trico Bank shares, which is the parent company of Tri-Counties Bank. This is a massive $2 billion deal.
Yes.
But unlike the Greenfire transaction, which was all cash, this is a 100% stock deal.
The mechanics of the exchange rate are fascinating here. Trico shareholders will receive 2.095 shares of First Hawaiian for every single Trico share they currently own.
Right. And when the dust settles, First Hawaiian ends up owning 65% of the newly combined Mega Bank, and Trico shareholders own 35%.
Creating quite the footprint.
Yeah, it creates an institution with $34 billion in assets, $22 billion in loans, $29 billion in deposits, and 117 branches spread across Hawaii and California.
Massive scale.
But I want to stick on the funding mechanism for a second. Why does a bank choose to use its own stock as currency instead of cash?
It is entirely about capital preservation. Banks operate under incredibly strict regulatory frameworks, especially regarding how much cash and high-quality liquid assets they must hold in reserve.
Right, to prevent a collapse during a bank run or an economic downturn.
Exactly. First Hawaiian does not want to drain its cash reserves, nor do they want to issue billions in new debt to buy Trico. By using a 100% stock deal, they simply print new shares of their own company and hand them over as payment. It keeps their balance sheet incredibly strong.
And the sources detail exactly how strong they expect that balance sheet to be. They are promising Wall Street some very specific financial metrics to sell this deal.
What are the targets?
Well, they project a 6% EPS earnings per share accretion, meaning the deal will boost their profits per share by 6%. They promise a 2.8-year earnback period, which is how long it takes to recover the initial costs of the merger.
Pretty standard metrics there.
Yeah, but the metric that really caught my eye was this: a pro forma CET1 ratio of 12.4%. I need you to translate that into plain English, because CET1 sounds like a droid from Star Wars. What is this CET1 ratio, and why does a 12.4% number actually matter?
Uh-huh. Yeah, CET1 stands for Common Equity Tier 1. For anyone who isn't a bank regulator, think of the CET1 ratio as a bank's ultimate financial shock absorber.
Okay, shock absorber. I like that.
It measures a bank's core equity capital, its absolute safest, most liquid assets, against its total risk-weighted assets, like the loans it has issued. If a massive recession hits and people start defaulting on their mortgages and business loans, the CET1 capital is the buffer that absorbs those losses before the bank goes insolvent.
So a higher ratio means a safer bank.
Exactly.
Right.
Regulators typically require banks to maintain a minimum CET1 ratio around 4.5%, plus various stress buffers that might push the total requirement to 7 or 8%.
Got it.
By promising a pro forma, meaning post-merger CET1 ratio of 12.4%, First Hawaiian is flashing a giant neon sign to regulators and investors saying, look how incredibly overcapitalized and safe we are. We have a massive shock absorber.
Okay, that perfectly explains the safety aspect, but the strategy behind the merger itself is what I find brilliant, specifically regarding the balance sheet synergy. The source notes that TriCo is liability sensitive, which helps reduce First Hawaiian's asset sensitivity.
This is the real genius of the deal.
Let's break down this concept of sensitivity because it dictates how banks survive shifting interest rates.
Right. Think of a bank's balance sheet, like a seesaw balancing interest rate risk. A bank makes its money on the net interest margin.
Which is what, exactly?
That's the spread between the interest it pays out to you on your savings account, those are its liabilities, and the interest it collects from businesses and homeowners on loans, those are its assets.
Okay, that makes sense.
So an asset-sensitive bank, like First Hawaiian, generally sees its profit margins expand when the Federal Reserve raises interest rates.
Why is that?
Because a large portion of their loans might have variable rates that adjust upward quickly, generating more income, while they can drag their feet on raising the interest rates they pay out to depositors. They love a rising rate environment.
Okay, but the flip side is a liability-sensitive bank.
Right. A liability-sensitive bank like TriCo gets violently squeezed when rates go up. Their assets might be locked up in long-term, fixed-rate, 30-year mortgages at, say, 3%.
Oh, right, so their income is fixed.
Exactly. But to keep their depositors from moving their money to a higher-yielding money market fund, they have to rapidly raise the interest they pay out on savings accounts to 4 or 5%. Their costs rise faster than their income.
So by acquiring TriCo, First Hawaiian is essentially buying the other side of the trade. They merge an asset-sensitive bank with a liability-sensitive bank to just smooth out the seesaw.
Precisely. The combined entity becomes much more interest rate neutral. It is the ultimate hedge.
Whether the Fed hikes or cuts.
Exactly. Whether the Federal Reserve decides to aggressively hike rates due to the inflation caused by that Strait of Hormuz oil shock, or whether they slash rates to stimulate the economy, this new Pacific giant is protected. It is a brilliant strategy for navigating macroeconomic uncertainty.
It is brilliant. But I want to challenge one of the major financial promises they are making to Wall Street in this source material because it looks like a glaring contradiction to me.
What's the contradiction?
So to make this $2 billion deal look attractive, First Hawaiian is promising a massive 25% in cost savings across the combined company.
Right.
But at the exact same time, they explicitly put in writing that there will be absolutely no branch closures. Tri-Counties Bank gets to keep its brand name in California. The CEO, Rick Smith, becomes a paid advisor. 4 TriCo directors get seats on the board.
Okay, I see where you're going.
Yeah. Usually, when a bank promises 25% cost savings, the first thing they do is fire a ton of middle management, close overlapping branches, and lay off the tellers. If they aren't cutting the physical overhead, how on earth do you mathematically save 25% of the running costs?
It is the great paradox of modern bank mergers, and to solve it, we actually have to loop all the way back to Section 2 of our deep dive. We have to look at the warning from the Nobel laureates about technology.
Oh, the technological tsunami, AI.
Exactly. The 25% savings is not coming from the frontline staff or the physical real estate. It is coming almost entirely from what the industry calls back-office synergy. It's about aggressively consolidating the digital infrastructure.
So the tech backend has become so astronomically expensive that merely combining it generates a quarter of the company's operating budget in savings.
Yes. Think about what a modern bank actually is today. It is essentially a technology company with a banking charter. They rely on massive core processing systems provided by vendors like Fiserv or Jack Henry. They spend absolute fortunes on mobile banking platforms, cloud storage, cybersecurity, regulatory compliance software, and increasingly complex artificial intelligence for underwriting loans and detecting fraud in real time.
All of which requires massive ongoing capital expenditure.
Right. And first, Hawaiian only wants to pay for one of those systems. When they merge, they don't need two core processors. They don't need two separate AI fraud detection vendors. They don't need two different cloud architectures.
So they just slash all the redundant software contracts.
Yes, they consolidate all those IT contracts, migrate all the data to a single platform, and negotiate massive volume discounts with the tech vendors. Scale makes the necessary technology affordable.
Wow.
Even if the physical brick-and-mortar branches remain untouched, the invisible digital infrastructure is being ruthlessly consolidated to strip out costs.
That perfectly illustrates how interconnected all these topics are. The AI technological arms race forces regional banks to merge, just so they can afford the digital tools required to survive the very macroeconomic volatility caused by things like the Strait of Hormuz. It is just a closed loop.
It really is. Which brings us to the final piece of our deep dive today. We have zoomed way out to look at global geopolitics, supply chains, and macro AI economics. We have analyzed billion-dollar corporate survival strategies in both energy and banking.
Right.
Now, I want to zoom all the way into the absolute micro level.
Because we talk a lot about mergers happening, but what does it actually look like minute by minute when a company ceases to exist and is absorbed by another?
It's a highly mechanical process.
We are looking at a NASDAQ corporate actions alert regarding a biotech company called XMA Royalty Corporation, which is merging into Legan Pharmaceuticals.
This gives us a fascinating glimpse into the highly choreographed plumbing of the financial markets. The transition of ownership doesn't just happen by magic. It requires a rigid, heavily regulated timeline executed by the stock exchange itself.
Here is the exact timeline detailed in the source. The shareholders officially approved the merger at a special meeting on the day of our sources, July 13.
Okay.
The stock is then halted immediately following the after-hours trading session at exactly 7:50 p.m. Eastern. The merger legally closes overnight prior to the market open on July 14, and the XOMA stock is permanently suspended effective July 15.
Let's break down the difference between a halt and a suspension because they serve very different mechanical purposes here.
Yeah, what's the difference?
A stock halt is a temporary freeze on trading. The NASDAQ initiates this at 7:50 p.m. to ensure that the order book is completely frozen while the corporate entity fundamentally alters its legal existence overnight.
Because you can't have thousands of shares changing hands and prices fluctuating while the company is literally in the process of being legally absorbed into another corporation. It would create a reconciliation nightmare.
Precisely. The halt freezes the game board while the lawyers change the rules. Once the merger officially closes on the morning of July 14, the old XOMA entity effectively ceases to exist as an independent, publicly traded company.
And then comes the suspension.
Right. The permanent suspension on July 15 is the NASDAQ officially wiping the ticker symbol off the board. It is the digital death certificate of the stock.
But the most interesting part of this alert is how the different investors actually get paid out, because it perfectly highlights the hierarchy of capital in a buyout scenario.
It's a great case study for that.
The sources detail three very different types of XRMA stock. First, there are depository shares, which are listed as a Series B 8.375% preferred stock. Then there is a perpetual preferred stock, which is an 8.625% Series A.
Both preferred classes.
Yes, and both of these preferred classes get a mandatory redemption of exactly $25 per share. No more, no less.
This perfectly illustrates the unique nature of preferred equity. Preferred stock sits somewhere between traditional stock and a bond in the capital structure.
That's so.
Well, it has a par value, in this case, $25, and it pays a fixed, predictable dividend percentage, which is why it appeals to income-focused investors. But in a buyout scenario, preferred shareholders generally do not get to participate in the upside premium of the buyout price.
They just get their flat rate.
Right. The acquiring company simply executes a mandatory redemption, buying them out at their predetermined par value. It is safe, predictable, and capped.
But the common stock, the regular XONA shares that most retail investors would own, they get a much more complex deal.
Oh, much more.
The alert states they get $39 per share in cash, PLUS, one non-transferable contingent value, right, or CVR.
The CVR is one of the most fascinating financial instruments, and it's utilized almost exclusively in pharmaceutical and biotech mergers.
I love this concept. Let me try an analogy to explain what this is for everyone. A contingent value right is essentially a scratch-off lottery ticket securely attached to a sure thing.
I like that.
So if you hold common stock, you get your $39 in cash today, guaranteed. But biotech companies are largely valued on the future potential of experimental drugs that haven't been fully approved or haven't hit peak sales yet.
Right, there's a lot of unknown future value.
Exactly. So if XOMA's underlying royalty pipeline hits a specific FDA milestone or achieves a certain revenue target 3 years from now, your CVR lottery ticket pays out additional cash down the line.
That is an excellent way to conceptualize it. The CVR is primarily a mechanism to bridge an intractable valuation gap between the buyer and the seller during negotiations.
Right, because Lemon Pharmaceuticals looks at XOMA and says, based on current data, your company is worth $39 a share. But XOMA's management looks at their clinical trials and says, no way, our new royalty pipeline is going to be a blockbuster. If you buy us now, you are stealing that future value. We're actually worth $45 a share.
Exactly. If neither side budges, the merger just dies on the table. So they use financial engineering to compromise.
With the CVR.
Yes. Ligand says, look, we will pay you the $39 in cash today, but we will attach a CVR. If your pipeline actually succeeds like you claim it will and hits those specific revenue metrics, the CVR triggers, and we will pay you the extra $6 per share later. But if the drugs fail or the FDA rejects them, the CVR expires worthless, and we only paid the $39. It aligns the risk perfectly between both parties.
And a crucial detail in the alert. It specifically notes the CVR is non-transferable, meaning once you get the scratch-off ticket, you cannot sell it to a hedge fund or another investor on the open market. You are locked in. You have to hold it and wait to see if the scientific milestones are met.
It is a brilliant, hyper-specific piece of mechanical engineering just to get a complex merger across the finish line.
And just like that, the legal documents are signed, the ticker symbol is suspended, the cash and CVRs are distributed, and XOMA disappears from the NASDAQ, quietly absorbed into the larger machine of Ligand Pharmaceuticals.
Yep, it's done.
Which brings us, perfectly, back to the massive macro picture we started with. We have covered an incredible amount of ground today, tracing the connections across the globe on a single day.
It truly emphasizes that the global economy is a single, hypersensitive, reactive organism. Geography, technology, and corporate finance are no longer separate disciplines. They are all one thing.
For you listening, just think about the domino effect we traced today, starting on July 13th, 2026. A drone ship fires a missile in the Strait of Hormuz. That military action threatens a 20% toll on maritime shipping, which dictates a sudden spike in the price of crude oil.
Right.
And that sudden surge in energy costs threatens the massive infrastructure build-out required for artificial intelligence, sending ripples of panic through Silicon Valley chipmakers, whose valuations are entirely dependent on hyperscalers buying their hardware.
Meanwhile, the rapid, unchecked evolution of that very same artificial intelligence prompts Nobel laureate economists to beg governments for macroeconomic foresight. Terrified at an impending labor shock that could hollow out the middle class in a fraction of the time it took the Industrial Revolution.
And in direct response to all of this chaos, the physical volatility of oil choke points and the digital volatility of technological transition, massive energy and banking giants like Greenfire and First Hawaiian are executing complex billion-dollar mergers.
Yeah, they are aggressively using rights offerings, bridge loans, and back-office tech consolidation to build corporate fortresses, all just to survive the exact volatility we discussed today.
It is a closed loop of cause and effect.
It is. And I want to leave you with one final lingering idea to mull over based on everything we have unpacked today.
What's that?
We talked today about how humans are scrambling to adapt our institutions to AI, and our corporations rely on human investment bankers and lawyers to execute these defensive mergers and find operational efficiencies. But consider the trajectory of the technology we discussed.
Where is this heading in your mind?
In a world where agentic AI is advancing as fast as those 16 Nobel laureates warn it is, how long will it be before artificial intelligence is the entity calculating the 25% IT cost savings of a bank merger?
Oh, wow.
Or instantly predicting the precise macroeconomic ripple effect of a 20% toll in the Strait of Hormuz on global supply chains, and then executing a corporate defense strategy in real time?
That is a wild thought.
Soon, the very technological tools causing all this macroeconomic anxiety might be the ones independently executing these billion-dollar market maneuvers. The tools become the operators.
And suddenly the map of the global economy isn't just a live wire, it is actively thinking for itself. Thank you for joining us on this deep dive. We hope this helped you connect the dots behind the headlines. Keep tracing those connections in your own reading, and we'll see you next time.